Welcome to this explainer. Today, we're pulling back the curtain on one of the absolute veterans of the IT sector, Wipro. We're going to take a deep, data-driven dive into their pretty complex FY25 and Q2 FY26 financials. Now, if you've been watching the tech sector, you know the narrative around Wipro has been, well, a bit of a roller coaster lately. But today, we're cutting right through the noise and letting the numbers do the talking. Let's dive in.
You've probably heard a quote like this floating around, right? For a while now, market sentiment has kind of pigeonholed Wipro as the, quote, younger sibling to giants like TCS, struggling to figure out its exact identity in a super fast-moving market. But hold on a second. Because when you actually peel back the layers and look at their real balance sheet, the picture is vastly different. And honestly, it's a lot more interesting.
So, to figure out if Wipro is quietly gearing up for a massive turnaround, here's our roadmap. We'll start with their financial reality, do a quick balance sheet x-ray, explore this fascinating revenue versus margin paradox, unpack some drama in their last quarter stats, and finally, look at their future outlook with AI.
All right, Section 1, Wipro's financial reality. Let's look at the foundation.
Before we talk about where the company's going, we really need to understand what it's standing on. And wow, just look at the sheer self-sufficiency here. For FY25, Wipro's total equity is sitting at an absolutely massive 8,25,779 crore rupees. Now contrast that with their long-term debt, which is remarkably low at just 64,000 crore. That's only a marginal bump from the previous year. So despite whatever stigma the market has, Wipro is operating on its own strength. They aren't bogged down by heavy borrowing at all. This low debt structure is a huge foundational strength.
Moving right along to Section 2, the balance sheet X-ray. Let's look at the asset growth hiding just beneath the surface of FY25. If we compare total assets year over year, Wipro jumped from 11.5 lakh crore in FY24 to 12.8 lakh crore in FY25. That is a rock-solid 11% year-over-year growth. It tells us the core machinery of the company is installing. It's expanding steadily.
And here is where it gets really compelling. Out of all those total assets, 5.33 lakh crore is sitting in total cash and investments. Specifically, that's about 1.1 lakh crore in pure cash, up 25% from last year, by the way, plus over 4.1 lakh crore in investments. Guys, this is a literal cash mountain. It acts as a phenomenal safety net during tough economic times, and it gives Wipro incredible fuel to just swoop in and acquire smaller competitors whenever they feel like it.
Now, of course, it's not just assets that grow, your obligations do too. Current liabilities did see a jump of 13.4%, hitting 2.86 lakh crore. But here's the crucial takeaway. Their current assets outpace that liability growth, expanding by 20%. So their ability to pay off short-term bills remains incredibly comfortable. Make no mistake, this balance sheet is undeniably healthy.
Which brings us to Section 3, the revenue versus margin paradox.
So if the balance sheet is so incredibly healthy, why is the market so skeptical? Well, look at the top line. IT services revenue actually shrank, dropping from $10,805 million in FY24 down to $10,511 million in FY25. That's a 2.7% decline, which naturally makes investors sweat. But check out the very next line. Their operating margin actually expanded from 16.4% to 17.5%. How does that even happen? Well, Wipro is essentially getting slim and trim. They're bringing in slightly less revenue, sure, but they are making more profit per rupee. Their operational efficiency has gone way up.
And the underlying metrics totally back up this efficiency. Over the last 5 years, they've maintained a 5% net profit compound annual growth rate, backed by a massive operating cash flow of over 1,69,000 crore. Their FY25 net income hit a very healthy 1,32,018 crore rupees. So yeah, they might be a bit smaller in total sales right now, but at 12.6 rupees per share, they are undeniably highly profitable.
All right, Section 4, last quarter stats, and a little bit of corporate drama.
Let's zoom in on the most recent data we have, the September quarter, Q2 FY26. Because there is some serious corporate drama hiding right in these numbers. During this quarter, Wipro actually posted revenue growth, up 1.7% year over year and 2.5% sequentially. Great, right? But their net profit dropped 2.5% compared to the previous quarter. So the billion-dollar question is, if revenue went up, why on earth did profit go down?
Well, the answer is a massive, unexpected hit.
An unnamed customer actually went bankrupt, forcing Wipro to make a sudden 1,165 crore provision for bad debt. That massive write-off dragged their reported margin down to 16.7%. Ouch. But here's what you really need to keep in mind. If you adjust for this one-time dramatic event, their actual operating margin for the quarter was a very strong 17.2%.
Drama aside, the quarter showed some really specific sector strengths. Banking, financial services, and insurance, the BFSI sector, is Wipro's absolute powerhouse right now. It brings in 34.3% of their revenue and actually drove sequential growth. The Americas 1 market is also holding strong at 33%. Basically, when banking is stable, Wipro is stable, simply because banks tend to be way more resilient with their core tech spending.
So let's objectively weigh all this out. On the strength side, Wipro has a cash mountain, incredible margin expansion, and a jaw-dropping $9.5 billion deal pipeline secured in just the first half of FY26 alone. That is huge. But the weaknesses are real too. Revenue has been stagnating compared to their peers, they rely heavily on discretionary spending, which gets cut first when times get tough, and client concentration is pretty high. I mean, their top 10 clients make up 24.5% of their revenue. Oh, and their EPS did drop significantly from 21.3 last year down to 12.6 currently. It's definitely a delicate balancing act.
Finally, Section 5, Future Outlook and AI. Let's see where they're heading. With all this data on the table, what's next? Let's check out their immediate guidance for Q3 FY26. Wipro is projecting IT services revenue growth somewhere between -1% and +1%. That's roughly $2,591 million to $2,644 million. Now, this is classic conservative Wipro. They're basically signaling a flat upcoming quarter while they navigate global macroeconomic uncertainty, crazy currency fluctuations, and just generally cautious spending from their clients. But hey, don't let that flat short-term guidance fool you. Just look at this number. In Q2 alone, they secured $2,853 million in large deal bookings. That is an explosive 90.5% growth year over year. Literally, these are the seeds of future revenue being planted right now. These large deals are moving into the execution phase, meaning they're going to start converting into actual revenue in the upcoming quarters.
And you know what's driving these massive deals? Artificial intelligence. CEO Srini Pallia has laid out an AI-first transformation strategy built on 3 main pillars. First up, AI implementation projects. Second, using AI automation to optimize costs for their clients. And third, high-level AI advisory services. They aren't just talking about AI like a buzzword. They are actively signing massive deals to actually build it.
So we're left with this final thought. Wipro right now is kind of like a heavy ship navigating through a massive macroeconomic storm. The top-line revenue engine, yeah, it's been sluggish, but their margins are highly optimized, their cash reserves are enormous, and they just secured a historic $9.5 billion deal pipeline fueled almost entirely by AI. So will this powerful new engine truly transform Wipro into a totally new avatar by FY27, or will the global economic headwinds just prove too strong? That, my friends, is the billion-dollar question you should definitely be